A family business on the verge of a sale is an emotional minefield. Imagine a boardroom, not with corporate raiders, but with siblings and cousins. One side argues to protect a lifetime of family history, accusing the other of selling out a legacy. The other side, pragmatic and stressed, sees a golden opportunity slipping away, drowned by sentimentality while the market gets colder. This is the moment a family business either implodes or moves forward. It's almost never about the spreadsheets. It's about history, identity, and the impossible task of putting a price on a lifetime of work. Get it wrong, and you don't just lose the business. You can lose your family. Welcome to teamOn Capital, the official channel of teamOn Corporate Finance, where every week we talk about corporate finance, business sales, company valuation, mergers, and acquisitions. For the past 15 years, I've helped families navigate this exact moment. The goal is to find a number, not just a number a buyer agrees to, but a number the family can live with. A proper valuation isn't a weapon for one person to win an argument. It's a map that gets everyone to the same destination, together. Stick with me. I'm going to show you how to value your family business, sidestep the emotional traps, and make sure you get what your legacy is truly worth. Section 1. The first step no one talks about: normalizing the books. Before we even touch a valuation formula, we have to do something called normalizing the financials. This is the most critical and, frankly, the most sensitive step for any family business. Family businesses are not run like public companies. Over the years, the line between business expenses and personal perks gets blurry. Perhaps the company pays for a luxury car that isn't just for client meetings. Or maybe a relative is on the payroll, but their actual role is hard to pin down. Valuators have to ask tough questions about whether family members are truly qualified for their jobs and if their pay is in line with the market. This isn't about pointing fingers. These things aren't shady. They're just the reality of a private, family-run company. But a buyer doesn't care about family perks. They only want to pay for the business's actual earning power. So the first thing we do is make add-backs. We take the company's profit number and add back all those personal or one-off expenses. This includes things like above-market salaries for family, personal trips, or even a country club membership. We adjust for all of this to find a number called EBITDA, earnings, before interest, taxes, depreciation, and amortization. This adjusted EBITDA is the real underlying profitability of the business. This is so important because it's not about judging the past. It's about making sure the family gets credit for every single dollar the business actually earns. For the family member worried about legacy, this proves the business's true value. For the one focused on the deal, it provides the hard data needed to negotiate with confidence. It turns an emotional shouting match into a productive, fact-based conversation. Hey, if you're getting value out of this advice, make sure to hit that subscribe button and turn on notifications. Because every week, we break down the complicated world of buying a business to give you the confidence you need to close great deals, navigate sales, mergers, and valuations. Section 2. The 3 lenses of value. Once we have that clean and normalized EBITDA, we look at the business through 3 different lenses. One method by itself is never enough, but together they give you a full 3D picture of what your business is worth. The first lens, the asset-based approach, this one's the most straightforward. We ask, if we had to sell off every asset the company owns, the buildings, the trucks, the inventory, and then paid off every debt, what's left? That gives us the net asset value. This is a useful number for businesses heavy on physical assets, like a manufacturing or trucking company. But for most businesses today, this approach misses the point. It completely ignores the most valuable assets: the brand, a loyal customer base, and the secret source of operations. So think of this as the valuation floor, a safety net number, but rarely the true value of a living, breathing company. The second lens, the market approach. Now this is where it gets interesting. The market approach asks one simple question: What have businesses like yours sold for recently? This is the most common method, and it's the one everyone tends to focus on. We do this by applying a multiple to that normalized EBITDA we worked so hard to calculate. For example, M&A data from the first quarter of 2025 showed a median EBITDA multiple of about 3.7x across all industries. But that number swings wildly. The information technology sector could see massive multiples, sometimes as high as 20.9x, while a restaurant might trade for closer to 3x. A good rule of thumb for most lower middle market businesses is a range between 4 times and 8 times adjusted EBITDA. So if our family's normalized EBITDA is $2 million, and similar companies in their space sell for an average of 5 times EBITDA, we have a starting valuation of $10 million. But we're not done yet. We have to adjust this for control. This is where we talk about a control premium. Because the family owns 100% of the company, they call all the shots. That control is incredibly valuable to a buyer. In today's market, a control premium can be a game changer. In the second quarter of 2025, the median control premium in the US was 30.8%. That means a buyer might pay a 30% premium on top of the market value just to get that total control. That one adjustment can literally add millions to the price tag. The third lens, the income approach. Finally, we have the income approach, which is all about the future. Here we use a method called discounted cash flow, or DCF. Instead of looking at past sales, we ask, how much cash is this business going to generate over the next 5 or 10 years? We project out all that future cash flow and then discount it back to what it's worth today. Why? Because a dollar you might get in 5 years is worth less than a dollar in your hand right now, thanks to risk and inflation. This method is extremely powerful, but it's also built on a foundation of assumptions. What's the growth rate? What are the risks? For a family business, the biggest risk a buyer sees is succession. Is there a strong management team ready to take over after the family leaves? If the owner is the key to every client relationship and the only one who knows how things work, that's a massive risk for a buyer, and it will drag the valuation down. This is why, for years before a sale, owners should focus on making themselves redundant, build systems, write down processes, and delegate authority. A business that can run like clockwork without its founder isn't just easier to sell. It's a hell of a lot more valuable. Section 3, the final layer, the family factor adjustments. So now we have 3 different numbers from our 3 lenses. The last step is to bring them all together and apply a couple more adjustments that are unique to private family businesses. First, we have to talk about the opposite of a control premium, a minority discount. Imagine a family where one member owns 80%, but 2 others each own 10%. On a per-share basis, their shares are worth less. Why? Because they don't have control. They can't force a sale, set the strategy, or hire a CEO. That lack of control gets reflected as a discount, which can be anywhere from 15% to 45%. A common benchmark derived from recent control premiums is around 23.6%. This is a huge source of conflict if it's not explained clearly, because it can feel like some family members are being punished. Second, we apply a discount for lack of marketability. You can sell shares of a public company in seconds. You can't do that with shares in a private family LLC. There's no public market. Finding a buyer takes a long, expensive, and complicated search. That illiquidity makes the shares less valuable, and a discount has to be applied to reflect that reality. By layering these adjustments onto our 3 valuation numbers, we don't end up with one magic price. We get a valuation range, and that range becomes the new foundation for the entire conversation. It moves the family away from emotional, pulled out of thin air numbers and toward a realistic, defensible zone of agreement. In a situation like the one we started with, this process can lead to a valuation range of, say, 11.5 to $14 million, it wouldn't be the fantasy number one person had in their head, nor the lowball offer another was willing to take just to get it over with. It would be something new, an objective number backed by facts. The arguments don't just vanish, but they change. They stop being about hurt feelings and start being about strategy. The family can finally have a logical discussion about the offer on the table. They can see how having a solid transition plan might push the final price to the high end of that range, and how a rushed deal could leave millions on the table. This is how you save the deal. But more importantly, it's how you can start rebuilding the bridges between family members. Selling your family business is one of the toughest things you'll ever do. It's a financial decision wrapped in a lifetime of memories. But by using a professional, objective process, you can cut through the emotional noise and focus on what's real. You get to honor the legacy of what was built and secure the future for the next generation. A fair valuation process is not just a business tool. It can be a tool for family unity. We have reached the end of this video. If you would like to continue learning about the world of M&A, subscribe to the channel and hit the bell. See you on the next video.